Capital gains tax changes? You betches there's going to be some changes. Watch this video as I go through the outline of the OTS reports released November 2020. Hi there, my name is Simon Misiewicz from Optimise Accountants, and I want to do a very quick video to demonstrate what impact the OTS report has on you as a landlord or someone who is selling other types of assets and the capital gains tax calculations. I'm going to do a much more detailed review in our Thursday video, but today I wanted to get a message out to you so you can start to think about, well, how does the new tax changes recommended by the OTS, and we'll go specifically who later on, and how you might then strategize going forwards. The Thursday video will give you a deep down review of the report and some examples of how it could affect you selling assets in the future. So this is a policy paper at the minute, it's recommendations, but my understanding from this report is that Rishi Sunak is certainly taking this very seriously indeed. I'm just going to zoom this up. I've highlighted this is the report. This is the information I'm going to be reviewing on Thursday. You'll notice that there's 135 pages. I'm going to do a detailed breakdown of that in our Thursday video. Today, like I say, I just want to give you an overview of what they're trying to do. So here you can see here, the OTS extensive consultation revealed a range of areas in which capital gains tax is counterintuitive. So it's all about, as it says here, equitable society, creating equality in regards to tax. The GAR, which stands for General Anti-Abuse Rule, for me was the start of that process to stop people using a limited company to get a tax advantage by doing the rent-to-rent scheme. Or indeed, in my view, using the LLP scheme, which says you are a partner as an individual, you own a full company as a limited company, and you move assets over across. Well, that was pretty much destroyed by GAR. So if you're doing that, please unravel that as soon as you can. But this is pretty much the second part to GAR now in trying to create this equality of taxation. See if I can move it even closer. Good, I can. So the second part is the simplification of design. And interestingly enough, what's Bill Dodwell, which is the tax director of the Office of Tax Simplification, said, if the government considers the simplification priority is to reduce distortions to behaviour, it should consider either more closely aligning capital gains tax rates with income tax rates. Boy, income tax rates? Really? So that basically means is that if you are a basic rate taxpayer, you pay either 10% if you are selling non-residential assets, or 18% if you're selling a residential property. Now that means that you're going to be moved instantly to 20%. So if you're selling a non-residential asset, well, now you are doubling your tax rate. If you're selling a buy-to-let property and you're a basic rate taxpayer, well, you'll be moved from 18% to 20%. So no real big deal. However, one of the things that you need to consider is when you sell an asset, the income from that asset increases your overall income, which basically could move you to being a high rate taxpayer. That is quite a danger because that means that as a high rate taxpayer, you pay 20% capital gains tax if you're selling a non-residential asset and 28% if you're selling a residential asset. Well, if you're a high rate taxpayer, you are now going to be asked to pay 40%, which is a big difference. That's 12% more tax than you did before. So this alignment, and interestingly enough, distortions of behaviour, so reduce the distortions of behaviour. Is it me, or is distortions of behaviour a good thing? So from an entrepreneurial perspective, a change of different perspectives might help us to look at things differently. If we're being ramroded into one system, and I appreciate simplification is great, but does it not stop entrepreneurship altogether? I'm really uncomfortable by this change if that is the methodology that they're saying, okay, we'll just have one system and everyone has a free-for-all. Creating a tax incentive provides everyone with an opportunity to do business. Now that's been taken away potentially, or at least in your own personal name. This pretty much nails the coffin now in terms of buying properties inside of a limited company, because the tax rate at the minute is 19% in a company. I say in a minute because there is going to be some clear differences between the current tax changes and, because of COVID-19, of what the corporation tax rate might be in the future. So that's my first nervousness. It could be more like 24%. The second nervousness is, well, if they're doing this for individuals, could they now try and reflect this in terms of limited companies as well? Who knows, but we'll dive into that on Thursday a little more. The annual exemption amount. So this is the capital gains tax annual exempt amount. So currently you can have £12,300 of tax-free money that you can put into selling an asset. Now, they aren't talking about reducing this level. Now, if you're a couple right now, you do benefit from 2 lots of 12,300, which quite nicely is 24,600 before you pay any capital gains tax. They are talking about reducing this level. Now, I wouldn't be too surprised if they ended up reducing it to a ridiculous low level, a bit like entrepreneurs relief. Now, that's an interesting one, isn't it? Because if this whole scheme is all about simplification, are they, Conservatives, now doing what Labour is trying to do by scrapping everything to do with entrepreneurs relief? Because if you remember, Rishi Sunak reduced entrepreneurs relief from 10 million down to 1 million. And there is a suggestion that it will be wiped out altogether in the future, which is horrifying, because now we're just being railroaded to being employees. And actually, this country needs entrepreneurs. Do you agree with that, by the way, or am I just talking nonsense here? The other thing that I picked up was interaction with lifetime gifts and inheritance tax. Capital gains tax incentives owners to transfer business and personal assets to others on death rather than during their lifetime. This may not be the best for business, the individuals or families involved, or the wider economy. So what they're saying is they could, if you think about inheritance tax is 40%. Well, actually, if you make this whole thing of scrapping capital gains tax rates, which is lower than inheritance tax, and move it to income tax, you may as well transfer it when you die, because there is no real benefit of doing any IHT planning anymore, because you pay 40% on death and you pay 40% income tax on transfer. Well, really, it doesn't make much difference to me. But what they did say is that they should consider extending gift holder relief. And this is Bill Dodwell again, by the way. Consider extending gift holdover relief to a broader range of assets. Now, holdover relief is typically given when you have an asset which is trade or a business, and there is something whereby you give it over and you don't have to pay inheritance tax. You can get away with it from that perspective. However, they're saying that they should make it more towards different types of assets and during their lifetime, which, is interesting, because it says, well, once you retire, you might want to pass over the assets over to loved ones who have the energy and the commitments now to carry on your business. So that now feels like it's trying to encourage entrepreneurs. But the first lot of stuff we've been looking at seems to discourage it. So it feels relatively confused. The Bill Dodwell again said the government should, having regard to pension policy more broadly, replacing business asset disposal relief with a more focus on retirement. So that's the thing we talked about earlier. But the interesting line here was the government should abolish investors relief. Now, that's an interesting one. What's the difference between an investor and a business person? In the eyes of HMRC, it is somewhat an investor who is passive. So they have an asset, they rent it out to someone else, whether that's commercial property, residential property, or indeed any other type of leases, well, that could be considered, well, maybe that's not such a business after all. A business is someone using an asset to encourage and develop their business to go forward. To abolish investors' relief, well, entrepreneurs' relief, maybe that could be one of the things that they're talking about. Maybe they could be looking at capital gains tax for investors and then scrapping that, and really creating this gulf between investor versus trade and developer. And that really does think, well, should you now become a developer rather than an investor? That's an interesting one. So maybe that could happen. So there's a bunch of information in this report. I will send you the URL to this. That will be below this video description. Feel free to have a read of that. This is just the outline, by the way. The 135-page report will be reviewed on Thursday, and I will have a look at creating examples. But today, I just want to get something out to you so you can start to think about, well, should I start to think about selling my assets sooner rather than later, given these imminent tax changes? Oh boy, there's a lot to think about. I'll see you this Thursday. My name is Simon Misiewicz from Optimise Accountants. I'll see you this Thursday.